Welcome to Stoxxies. Today, we will talk about the doomsday rhetoric that prevails in the world of markets at times. Every few weeks, we hear the same headline over and over again. The crisis is coming, markets are collapsing, get ready. We have seen it many times, in 2008, in 2011, in 2020, and again today. And yet here we are. Not only did the markets not collapse permanently, but they often recovered faster than we imagined. Today's video is not for panicking. It is a cool look behind the noise at what really happened in the biggest historical falls, how quickly the markets recovered, and why crisis predictions often seem scarier than they are. Stay tuned until the end of the video, and you will not regret it. Let's get started. Let's start with the facts. If we look at the Dow Jones and the S&P 500, there are some historical moments that we all remember. 1929, the Great Depression, 86% drop in the Dow Jones. 1973, 74, oil crisis, 45% drop. 2000, 2002, dot-com bubble, 49% drop in S&P 500. 2008, financial crisis, 57% drop. 2020, COVID-19 pandemic, 34% drop in a few weeks. In all these cases, markets recover. After 1929, it took about 25 years to reach pre-crisis levels again. After 1974, just 5 years. After 2008, about 4 years. After 2020, just 5 months for a full recovery. The first lesson is clear: crashes are part of history, but markets adjust and bounce back. And now you wonder, why do they keep telling us that the crisis is coming? The answer is simple. Fear sells. News needs drama. Headlines need tension. No one is going to click on an article that says, markets are likely to remain stable for a while. Instead, the disaster is coming grabs attention. The result? People hear panic, while the markets continue to move as they always have. Psychology plays a huge role. When everyone is scared, investors tend to sell en masse. But history shows that mass panic selling often creates opportunities for those who remain calm. A simple example. During the pandemic in 2020, the decline was sharp and intense, but those who bought during the decline saw their profits return within a few months. History repeats itself, but not always in the way that the headlines scare us. Markets must be viewed with a long-term perspective. Short-term waves of panic and decline are inevitable, but the fundamentals of the economy and innovation often resist the noise. From 1929 to today, a simple investment plan that followed the S&P 500 index would have yielded huge profits, despite the big drops. The message is clear: time trumps fear. We are not saying that crises do not exist, they do, but there is a difference between crises with a real impact on the economy, like 1929 and 2008, and fearful predictions that never come true, like every article that claims that the Great Crisis is coming now. The second category is what creates panic for no reason, and it usually occurs every year, regardless of the fundamentals. What can we learn from all this? 1. Don't just listen to the headlines, look at the data. 2. Dips are normal and often create opportunities. 3. Long-term strategy, short-term panic. 4. Cool wins. Markets don't tune into your emotions. In short, the coming crisis often doesn't actually exist. Or if it does, markets quickly factor it in. If there is one lesson from 100 years of history, it is that markets are more resilient than we think. And doomsday predictions are often a storytelling tool, not an accurate measure of reality. The biggest risk to us is not the bubble or the bust. It is believing the panic and acting hastily. What do you think? Are market bubbles real or just media exaggerations? Let me know your opinion in the comments. If you liked this cool look at the markets and the data, like the video, subscribe to the channel and press the bell so you don't miss the next videos with investment analysis. Why the economy needs less fuss and more knowledge and patience. Markets don't know panic. We need to learn to stay calm.